As China closed its doors to the world in a bid to stamp out the COVID-19 virus about 3 years ago, critical supplies to the global economy came down to a trickle. After all, China has been the manufacturing backbone to the global economy. Companies that had bet on a liberalized global supply chain began to be stung by these moves, and they started looking at alternative supply chains. So as companies started formulating their China plus one strategies, the big question arose: which country would step up and be the plus one? Only time will tell, but let's take a look at how India has done in these past 3 years. Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. Last week, World Bank President Ajay Banga said that India has a window of only 3 to 5 years and not more if it wants to make the best of the China plus one opportunity and attract investments. Media reports quote the Indian origin and former MasterCard CEO Mr. Banga as saying that he was more optimistic about India's prospects now than earlier because of the country's focus on growth and jobs. China plus one is not just a philosophical concept anymore. We are seeing it taking shape in the real world now. Recently, an Indian wheel manufacturer set up a new aluminum wheel plant only because one of its clients wanted to move away from traditional supply chains. In January this year, Japanese newspaper Nikkei reported that Dell, a computer maker, had announced that it would phase out China-made semiconductor chips for use in its computers by the end of 2024. Before we review India's performance on this front, let's take a look at one other country, Vietnam. Historically, Vietnam has been very good in attracting foreign investments. If you look at a 2-decade period ending 2020, the contribution of manufacturing to its GDP has doubled, and it stood at about 25% of GDP in 2022. And why manufacturing? Because it's a good indicator of how well a country has been able to attract investments. For India, in that same period, it inched up from about 15% to about 17.4% in 2020. Industry observers point out that one reason why Vietnam has hogged all the headlines with regard to corporate investments is because of its geographical proximity to China and its long coastline. In order to compete with these nations, even pre-pandemic, India in 2019 announced a far lower corporate tax rate at 15% for new manufacturing units, and this has been consistently extended. Now the expiry date for the same program is March 2024. But investment announcements in India have not been consistent. There's been an ebb and flow. The surest sign of investment flows is the FDI metric, or foreign direct investment. For India, that figure rose to its highest ever in its history at $83.5 billion for the year ended March 2022. From the chart on your screens, you can see that there was a steady increase from fiscal year 2018-19 onwards till fiscal 2021-22. Then, for the fiscal year ended March 23, there was a decline for FDI by 16%. And mind you, this was in a period when China's PMI, or Purchasing Managers Index, for the manufacturing sector had seen a contraction in 7 out of the last 12 months. The PMI is a lead indicator based on a survey that shows optimism and business confidence, in addition to export signals and employment trends. Now, let's take a look at Vietnam. From the chart on your screens, if you look at Vietnam's trending graph for FDI, the quantum of investment, of course, may be lower than India's, given the size differences, but the trajectory over time has been upward. Media publication Asian Insider says Vietnam has captured an estimated 10% of manufacturing investments relocating away from China. But Vietnam has been hit hard recently on the economic front. An S&P Global report in June showed that there were severe power outages stemming from heat waves and a spike in demand for power, and this has impacted factories intensely. Vietnam is an economy that is dependent on exports, and because of the global economic gloom, exports have been muted, and that has impacted GDP growth. GDP growth fell from 8% for full year 2022 to about 3.3% only for the January-March 2023 period. If India plays its cards well, even from now on, which industries here could benefit? Domestic brokerage Angel One bets on 3 industries that could be gainers. First is the IT and ITES. Under this umbrella, it includes electronics manufacturing. News of Apple increasingly and gradually moving more of its production away from China to India is alone evidence of this. The brokerage is also optimistic about the pharmaceuticals industry in India capturing a major share of companies moving away. It says that the industry currently valued at about rupees 3.5 lakh crore will grow to about rupees 10 lakh crore by 2030. And obviously, investments will spur this growth. Angel One is also gung-ho about the metals industry. It points to China's increasing demand, domestic demand for steel, which means that other countries like India could hope to fill in the vacuum that China leaves in supplying steel to the rest of the world. And here are a few factoids to support that assertion. In May 2021, China withdrew all export rebates. Further, processed steel products such as hot-rolled coil may soon start attracting an export duty of 10 to 25%. This is with an aim to making available steel for the domestic market. The world, it says, will likely look towards India to fulfill its metal needs. The natural resources of India are capable of meeting the demands of domestic as well as global metal industries, the brokerage says. It also cites India's production-linked incentive scheme for the specialty steels industry, which is projected to attract about 40,000 crore rupees of investments over 5 years. In the last few minutes, we've seen or talked about investments in these two countries, but we did start this episode talking about the supply chain. So let's take a very quick look at how players in the supply chain itself look at prospects for India. In January, a survey by online platform for container logistics, Container Exchange, showed that 67% of 2,600 respondents among industry professionals believe that India and Vietnam will rise as functioning container shipping hubs. So here's one more opportunity for India. However, in whatever bright light the rest of the world seems to look at us, it's always good to turn an introspective eye and look at where we are lacking. In March this year, a parliamentary committee for commerce tabled a report in Parliament that stated that India had failed to create a positive impression among investors looking for alternatives to China. It said India has not been able to take advantage of this opportunity, whereas smaller South Asian countries such as Vietnam, Thailand, and Cambodia have become the biggest beneficiaries of the China Plus One strategy. Despite availability of resources and planning, India has not been able to create a positive impression among businesses that are moving away from China. The panel pointed out that these three nations and other small countries in the region have emerged as viable alternatives for machinery, automobiles, transport, and electrical equipment industries, shifting their manufacturing bases away from China. The committee pointed out in the report that cheap but skilled labor, lower corporate income tax, and a proactiveness in signing free trade agreements with specific countries and conducive business environments were all additional advantages that these countries enjoyed, in addition to their geographical positioning advantage. The panel recommended that measures such as rationalization of direct and indirect taxes must be done in sync with international norms so that it can increase the competitiveness of domestic industries in the global markets. Before we wind down this episode, as usual, here are a few nuggets from our Did You Know section. The war in Vietnam lasted about 2 decades, starting shortly after the Second World War. It was seen by the world as a proxy war for the Cold Era confrontation between the US and Russia. The US gave up involvement in 1973. Cut to the 2020s, Vietnam exported about $80 billion worth of goods to the US in 2020. That's all we have for now. But before you go away, if you're watching this on YouTube, do not forget to like, share, and subscribe. And here is a quiz question for you. In the last episode, quite a few people responded to our quiz question. We urge more of you to do so this time. And the question this time is, where do you think Vietnam's total annual exports stand? And how do those compare with India's exports? Till we meet again, have a lovely week ahead.